Welcome to the deep dive. Today we're zeroing in on a tool you hear about a lot in stock market technical analysis, Fibonacci retracement.
Right. Sounds maybe a little intimidating.
Yeah, maybe a bit. But, fundamentally it's about trying to figure out where a stock price might find, let's say, a floor or a ceiling when it pulls back for a bit, a retracement
Yeah.
within a bigger trend.
Exactly. And we've got a source, a YouTube video transcript, that actually does a pretty decent job of breaking it down, making it less complicated than it might sound.
Good. So our mission today is pretty clear. Really get the nuts and bolts of Fibonacci retracement and see how people use it to spot potential buy or sell points during these retracements. Doesn't matter if it's an uptrend or downtrend.
Precisely. Because markets, well, they don't just go straight up or straight down, do they?
No, definitely not. There's always that ebb and flow.
And this tool tries to give you a framework for guessing maybe how far that ebb might go or how high the flow might reach before the main trend kicks back in. The video focuses on the practical application, which is helpful.
Okay, let's start with the foundation then. The source talks about, well, Fibonacci numbers first and the ratios you get from them. Things like 0.236, 0.382, 0.5.
0.618, 0.786. Yeah. The video points out they're seen as kind of natural. They show up in nature, like in spirals of shells or plant growth patterns.
It's pretty wild, isn't it, that these numbers from nature are thought to apply to something like the stock market. Is there any, theory on why that might be?
Well, it's debated, of course, but one idea is that these ratios maybe reflect crowd psychology somehow, or, there's the self-fulfilling prophecy angle.
Ah, right. If enough traders are watching these specific levels.
Exactly. If lots of people place orders around, say, the 61.8% retracement level, then their actions make that level significant. It sort of becomes important because people believe it's important. A feedback loop, kind of.
That's interesting. Okay, so whether it's nature or psychology, the core idea is these ratios might flag potential support and resistance zones, points where price might react.
Correct.
So to use them, we need to be clear on retracement. What exactly is it?
So, think of it like this. If a stock is trending up, making higher highs, higher lows, a retracement is when the price dips down temporarily, before hopefully heading back up.
Okay. And the opposite for a downtrend.
Yeah. Lower highs, lower lows defines the downtrend. The retracement is when the price bounces up for a bit before potentially continuing its downward path.
Got it. Like taking a breath or a slight detour before getting back on the main road. And the big question is always, how far is that detour going to go?
That's the million-dollar question, right? Is it a small dip or a big one?
And that's where Fibonacci retracement steps in as
Yeah.
a potential guide.
Exactly. It's a tool to try and identify those likely levels where the retracement might run out of steam, where support might appear in an uptrend or resistance in a downtrend. The assumption is these ratios act like potential turning points.
Okay, cool. So we've got the concept. Now, how do we actually apply it? Let's start with a downtrend scenario. The video gives specific steps, right?
It does. In a downtrend, you typically apply the tool from the most recent significant swing high down to the most recent significant swing low.
Okay, let me picture that.
Yeah.
Stock's been falling, lower peaks. We spot the last main peak, that's the high. Then the valley it fell into, that's the low. We connect those 2 points with the Fibonacci tool. Then what? What do the levels mean?
So those levels that pop up on your chart, the 23.6%, 48.2%, 50%, 61.8%, 78.6%, they now represent potential resistance areas.
Ah, okay. So as the price tries to bounce back up from that low.
It might hit its head, so to speak, at one of those levels. Selling pressure could emerge around, say, the 38.2% level, pushing the price back down to continue the downtrend.
Right, so it bounces, maybe struggles at the 23.6%, maybe pushes through, then hits resistance harder at 38.2% or 50%. And the video mentions if it gets rejected at, say, 38.2% and then falls back below the 23.6% level.
That could be seen as confirmation, yeah. Like, okay, the bounce failed and the downtrend is likely resuming. Each level is a potential battleground between buyers trying to push it up and sellers defending the downtrend.
Got it. It's like hurdles the price has to clear on its way back up.
That's a good way to put it.
Okay, let's flip it. What about an uptrend? Price is generally climbing, higher highs. How do we draw the tool then?
It's basically the reverse. You connect the most recent significant swing low up to the most recent significant swing high, capturing that upward move.
Makes sense. So price is rising. We see a clear recent bottom and the subsequent peak. Draw the tool from bottom to top. Now, what do the levels tell us here?
Now, Those same Fibonacci percentages act as potential support levels.
Ah, okay. So if the price pulls back from that high,
It might find buyers stepping in around those Fibonacci levels, like the price dips to the 50% level, finds support, and then resumes its climb. They're potential floors this time.
okay, so you might look for buying opportunities around those levels if you think the uptrend is still strong. The video gave an example, right?
Yeah.
Finding support near the 50% level.
Yeah, and it also noted that if the price breaks down below the 78.6% level,
Oh,
right, that could be a red flag. It suggests the pullback is maybe too deep for just a normal retracement in a strong uptrend. It might mean the trend is weakening or potentially even reversing.
that's a critical point.
Right.
So below 78.6%, you start to question the uptrend itself.
It definitely raises caution flags, yes.
Okay, the source gave some real stock examples too. Reliance during a downtrend.
Yes. They showed drawing the tool from a high to a low, and the price apparently ran into resistance near that 23.6% level before heading lower again. It just helps visualize how price can sometimes react near these areas.
It makes it more concrete than just talking theory. And then there was another one, an uptrend on a shorter time frame, like 5 minutes.
Right. An unspecified stock, they drew low to high, and the price pulled back to the 50% level, found support, bounced. It also showed some reaction at the 23.6%. So it suggests these levels can be watched on shorter terms too.
Although you mentioned earlier, and I think the video did too, that they tend to be more reliable on longer time frames.
Generally, yes. Longer time frames, like daily or weekly charts, often carry more weight. The levels are based on more significant price moves, but traders do use them on all time frames.
Okay, so let's recap the main takeaway here. In an uptrend, Fibonacci levels equals potential support.
Correct. Potential places for price to bounce up from.
And in a downtrend, Fibonacci levels equals potential resistance.
Yep, potential places for price to turn down from. It's about anticipating where those counter-trend moves might end.
Got it. The video also touched on something else using Fibonacci after a big high and low are already set to find future resistance.
Yeah, the idea is that even after a downtrend seems to have bottomed out, if you draw Fibonacci from the major high to the major low of that whole move, those levels might still act as resistance on the way back up later on.
Like the market has a memory for those levels.
Sort of. They showed an example where price, after a downtrend, kept hitting resistance around the 38.2% level on multiple attempts to rally, so those levels can remain relevant for a while.
Interesting. Now, what about combining this with other things? The source mentioned PCR and AutoTrender briefly. Why do that?
Well, like we said, no single indicator is perfect, right? So traders often look for confluence, multiple signals pointing the same way. So maybe the put-call ratio, PCR, is very low, suggesting the market is oversold and maybe due for a bounce. If that happens just as the price hits a key Fibonacci support level in an uptrend.
Ah, that gives you more confidence that the support might hold.
Exactly. Or if a tool like AutoTrender is strongly confirming an uptrend, it reinforces the idea that you should be looking for buys at Fibonacci support levels, not trying to short resistance. It's about building a stronger case.
Makes sense. Get more evidence on your side. And finally, just to reiterate the time frame point, longer is generally better.
Yeah, the video emphasized that. Daily, weekly charts, the signals from Fibonacci on those tend to be more significant, more respected by the market, you could say, than on like a 1-minute chart.
Okay, so wrapping this up then, Fibonacci retracement, it's essentially a method to try and measure how deep a pullback might go within a trend.
And identify those potential zones where it might stop. Support in uptrends, resistance in downtrends.
Based on these ratios that, well, intriguingly appear in nature, offering possible clues for finding entry or exit points.
That's the goal, yes, using it to anticipate potential turning points in those retracements.
All right, so here's something to chew on. How could knowing these potential retracement levels maybe help you think about risk, or where you might get in or out of a position?
Yeah, and maybe how combining this view with other analysis techniques could give you a richer picture of what the market might be doing.
Definitely worth exploring. Maybe pull up some charts yourself, different stocks, different time frames, and just see if you can spot these Fibonacci levels playing out. It could add another layer to how you analyze market moves.